to another episode of Unlocking California Politics. I'm your host, Sanjay Wagle, and today's episode will focus on the extremely complex and difficult issue of homeowners insurance in the state of California. Today, we have returning with us for the third time Amy Bach, the Executive Director with the Consumer Group United Policyholders, and Steve Young, Senior Vice President and General Counsel with the Independent Insurance Agents and Brokers of California. Welcome to both of you. So welcome back, Amy and Steve. And Amy, before we begin, if you could talk a little about what United Policyholders is and does.
Thank you. It's a pleasure to be back with you, Sanjay. I know the issues we're going to be talking about have a very big impact on your members and on the clients that they serve in their businesses. So United Policyholders is a 501c3 nonprofit. We are in our 34th year of service to policyholders around the country. We're based here in the Bay Area, but we do work around the country. We have staff in Colorado. We have a staff person in Florida and staff person in Hawaii. But our main work really does take place here in the state of California. We run 3 programs: the Roadmap to Preparedness, through which we are helping people reduce risk and be properly insured; the Roadmap to Recovery, to which we are right now in 3 wildfire impacted areas in the state, offering free classes and guidance and a variety of support services aimed at helping people make good decisions, avoid mistakes, keep forward momentum, navigate the insurance claim process, make their rehousing decisions, rebuild, buy, move, stay, and get through the recovery process with as much support as we can give them. And then their advocacy and action program, through which all of the work kind of merges into looking to solve problems. So what we're here talking about today, the challenges that people are having holding on to their property insurance, not just individuals, but also businesses. So rising premiums, shrinking competition, and then all the noise that you hear in the media about the commissioner's activities and State Farm and all the drama that's playing out on the front pages of newspapers and on broadcast media every day.
And Steve, could you tell our audience about your organization, the Independent Insurance Agents and Brokers of California?
Yes, Sanjay. First, thank you for the opportunity to appear on this panel. I'm very honored to appear with my friend Amy Bach. Amy and I, disagree from time to time, but we have immense respect for the job that United Policyholders does. And Amy has a long and very well deserved reputation, not only for being very knowledgeable about this industry, but very honest in her advocacy. So really appreciate that. And Sanjay, we're so grateful to the California Association of Realtors. The realtors have joined with the independent agents and brokers and many other industries outside the insurance industry to really help elevate the severity of this insurance crisis in the governor's office, in the insurance commissioner suite, in the halls of the state legislature. And we believe that coalition has been very instrumental in driving the efforts toward reform that we are now in the process of implementing. IIAB-CAL is a 501c6 nonprofit organization, and we serve independent insurance agents and brokers. And those are the brokers who do not work for any one company, but have the contractual freedom to either represent or do business with a wide variety of competing insurers. That's sort of historical because there aren't a lot of competing insurers in homeowners insurance right now. We're going to talk more about that in a second. But independent agent brokers do business throughout California, doing a lot of commercial insurance, but also a very significant degree of personal lines insurance as well. So again, we're very honored to be with you all today.
Okay. So California's home insurance market was already challenged prior to the Los Angeles area fires. And I don't know if either of you recall this, but I think that's the first time we had the two of you on a podcast. I think there's some discussion if we could only have 2 years without fires, then we could stabilize the market. And it's like,
There was so much optimism going into 2025, and then wham!
exactly.
Yeah.
But there was, and as I said, prior to the recent Los Angeles fires, there was hope on the horizon from the Commissioner Lara's sustainable insurance strategy, which I believe all our groups, I think it's fair to say, support. That strategy, among other provisions, would allow insurance companies greater flexibility in their rate filings by allowing catastrophic risk modeling and reinsurance to be considered, also has incentives for writing policies in areas where there's heavy penetration of the FAIR plan. Then, in January, right as those regulations were ready to move, the fires hit California hard. So I'm going to start with how these events have impacted California's already challenging home insurance market, and in particular, how they might be affecting the sustainable strategy. And one other question within that, if you could address, is do you think the sustainable strategy has helped maybe keep this from being a worse insurance situation than it otherwise might have been? And I'll start with Steve.
Sanjay, I'm absolutely delighted to answer that question. If we can just schedule another webinar for about 18 months from now, all of those things will be apparent. The reason that, from our perspective, that the availability crisis in California has been so much dramatically worse than in other Western states, which also face the same wildfire exposures, is that the regulatory system here for 30 years plus has deprived insurers of the opportunity for adequate rates, and they have slowed down the process of making rate change applications. Here, as your realtors know, insurers must get the approval of an elected insurance commissioner to raise rates beyond a relatively small degree. And there are other aspects of that process that are built in that slow everything down. We are cautiously optimistic that the reforms that the insurance commissioner has embraced and is now in the process of implementing can correct both of those deficiencies, that they can and will, depending on how the commissioner implements these rules, provide a greater opportunity for adequacy, especially in a lot of these monumental exposures that insurers face, and will produce quicker rate decisions. It can take an insurance company 2 years to get a decision out of the Department of Insurance on a rate increase, by which point it's almost irrelevant. The data already is so outdated at that point. So we're hopeful that these reforms will work, but it's going to be a while. It's going to be at least probably until 2026 at the earliest before we start to see relief, because the department, even though it has promulgated new regulations, has a series of additional steps that it has to take to fully implement these reforms. And insurance companies then have to file with the commissioner and get approval, not only of new rating plans, but also the commitments that you referenced, Sanjay, to either continue writing or to write new business in the areas that have been underserved the most. With that background, I'll answer your question now, which is that honestly, we don't think, again, cautiously optimistic, that the catastrophe in Los Angeles County from January will necessarily slow down these reforms. Everyone knew that the Pacific Palisades area was one of the worst, most highly concentrated, overexposed areas for fire loss. So it's horrible. It's a horrible catastrophe. It's going to take decades for those areas to recover. But it wasn't a surprise. It wasn't like some fault line that no one knew about. That's why so many insurers had non-review policies in those areas. Is why the FAIR Plan had so much business. So we're hopeful again that even though the magnitude of that crisis is still being calculated, that it will not slow down the potential for reform. And ironically, here's the counterintuitive point. We actually think that there is an incentive for insurance companies to come back to the market sooner rather than later, because the reforms are designed to encourage insurance companies to take business out of the FAIR Plan or to write. And the sooner a company comes back, the better cherries they will have the opportunity to pick, if you will, in terms of getting back into the market.
Well, certainly, I'm a policyholder advocate. So, never really excited about rates going up, right? And also, but very pragmatic, and in the sense that, when my organization has been offering these, we've been offering shopping help webinars to consumers for many years. And we had like this 3-column template that we give people to say, when you're shopping, here's where you can write down your 3 options so you can compare your 3 options and just apples to apples and decide which is the best. And that, obviously, like, that would look silly, for us to be putting that out there. So we've had to really evolve a lot of our positions and guidance as we navigate what everybody describes as unprecedented marketplace conditions, right? For many, many of the consumers out there, they don't have three options. They either have one option, the FAIR plan, or they have, in many cases, they have two, the FAIR plan or a company they've never heard of who has a either no track record on actually paying claims, a good track record on selling, but maybe not a real track record on actually paying claims. So given the how hard this market is for consumers, we have spent a lot of time and effort dialoguing with insurance companies, dialoguing with the regulator, trying to figure out, what can we do? It took a while for us to come around and support the sustainable insurance strategy fully because there's no question it's going to cause rates to go up even more in a lot of ways. Although we still have this belief, I have this belief that if we get people out of the FAIR plan and back into the private market, get them out of that high risk pool with, where of course the rates are high. They're in there with a lot of other high risk people. You don't have that, counterbalance effect of there being lower risk people in there to balance the pool. Then they should be, getting some better quotes out there if we start to get more competition. So we very much want to stimulate competition. So we support the sustainable insurance strategy. And to be honest with you, I am convinced that if the commissioner hadn't gotten all those pieces in place by the end of last year and he did workshops all year long, a lot of public hearings, and took a lot of input. Some people would say too much input, but eventually they got it all done by the end of the year. Had he not done that, and then we had the LA fires, I would say we'd be looking at a very different picture right now. The the week after those fires hit, I reached out to the two insurers that they had been working with my organization's wildfire risk reduction asset, our WRAP working group, where we've been working for 6 years to try to really speed up the number of homes that are hardened and have defensible space and spreading best practices between communities around the state on funding grants and doing big community programs to get the maximum number of homeowners going, okay, we're gonna do this, we're gonna do this. I checked in with the two insurers that have been rewarding people who've been reducing risk, which is a big goal we have, right? By renewing them, which is very important, they've been rewarding people by giving discounts. We circled back with both of them. You probably don't want me to name names, but I mean, I can because I'm actually proud to praise them because I want other carriers to follow their suit. Mercury and CSAA, both of them, I checked in with their representatives after the fires and they said, well, no, we're still on track here. One of them had committed in December. Mercury had gone up to Paradise. They saw the good work that was being done, right? And they said they were going to write another 200 homes. I called our guy there and said, are you still going to do that? And he said, yeah, we are. We're not planning to backtrack, although we might postpone maybe a couple of months that strategy. And then similarly, the other carrier said, no, we're still on track to try to, we're sticking with the IBHS. If you don't get your certification certificate from IBHS, we're not going to renew you. But if you do get that, that's going to put you in a much better position. That's where we're trying to go, Sanjay, with the strategy that's in place, with the PRID process where we've already got, yes, it's more bureaucratic than insurers would like to see, but I think the department is striking that balance between acknowledging that they've been slow, acknowledging that the carriers have a point, that they need to get more certainty with their rate adjustments. They've acknowledged it. They've been granting a lot of increases. The insurers have gotten all the tools they said they needed. Maybe they're not, moving as quickly as they'd like, but they're all in place. I think that the problems that we have are very serious, deep problems that are not going to go away anytime soon. But I do think that there's still a lot of appetite in the insurance sector for insuring properties here in California, and that we are on the right path towards restoring a healthier market and trying to get the depopulating the FAIR plan in a healthy way, not the way they've been doing it in some other states.
Stephen, I see you nodding. Generally agree?
Yeah, I do generally agree. I think the one thing that we have to keep in mind though is that everything depends. on how the insurance commissioner actually implements all of these new tools. None of these new provisions, which by the way are already existing in virtually every other state. California has been an outlier in not permitting catastrophic modeling in rate making and not allowing credit for reinsurance costs and taking so long to review rates. But none of these are self implementing. Insurance companies have to present a plan to the commissioner and get the commissioner's approval in order to get the green light to get credit for reinsurance costs, for example. And so we're hopeful that Commissioner Laura will implement these new rules in the way that will help consumers, will help restore competitive health to the market. But oh boy, his term ends, after 2026. And so a great deal depends on who comes in after him as the commissioner and whether these new tools can somehow be sort of locked into statute or whether they remain fully changeable or revocable by the next commissioner.
Good point. So I'm going to next move to policyholders in the areas affected by the recent fires. So the first question isn't going to be related to kind of areas surrounding these fires and in the areas because there is the 1 year moratorium in specified zip codes regarding canceling insurance policies. I'll start with Amy. Are you hearing about anything that's problems with the moratorium and also I guess just generally what you're observing in terms of how insurance companies are responding?
Well, look, the non-renewal moratorium is incredibly important because it's a calming measure, right? I think, there's a certain, insurance executives go on data, but they also go on perception. And, I think we've seen after large scale wildfires before, we have seen, some carriers hit pause just because they see a lot of red ink and it's not necessarily logical, right? The trees are all burned. How's, what it's not more dangerous now. It's just that it gets on their radar is like, what were we doing? Why were we writing so many homes here? So there's a bit of that. But so I think the more non-renewal moratorium really does help. And it also obviously it helps because a lot of these people who are living in the vicinity are not going to be very attractive, risks for insurers. So they need a little extra help being, kind of in the bullseye range. There is a problem with the way the moratorium is worded. There's a couple things. One, it doesn't protect small businesses. So I think, the legislature, there's a bill pending that would fix that. But also there's a pretty big loophole in it, which we've had some consumers complaining about, which is they're not allowed to non-renew you solely on the basis of wildfire risk. But they can find other reasons. So we have had people who are in the non-renewal moratorium zip codes still get non-renewed. And they're, of course, because the insurer has said, oh, well, something else, right? It's your outdated, knob and tube wiring, or it's your mold on your roof, or it's something else that we found, right? So that loophole is a bit of a problem for some people. It's this relatively small thing. So I think, again, that's sort of one of those things where I think I'm not saying that the department has like been just perfect and everything they're doing is awesome, but I have to say like they have been bringing solutions, very concrete, and the legislature, I think, definitely gave them a lot of room to drive their approach. We haven't seen a whole lot of legislation the last couple sessions. Now we're seeing a lot. I think we'll see what happens in this session. I think a lot of legislators are kind of getting their constituents or they're having a harder time answering their constituents. Why aren't you doing more about this? So I think we've got some good stuff in place. I think one of our biggest challenges still is the fact that we don't yet have a solid rule that would give a homeowner a fighting chance to make the improvements that would bring them into eligibility with an insurer's guidelines and then give them the opportunity to be renewed. And that's one of the most sensitive points, which I'm sure politically because we've already got a situation where insurers have been very vocally unhappy with the regulatory environment here. And there are quite a few legislative mandates on them, to include code upgrade coverage and to extend to offer up to 36 months of temporary rent and things that they otherwise would have probably not been that excited about being required to do. So we have all those things. I think the challenge for lawmakers is going to be, can we take that next step do we want to be the first state in the country, as far as I know, to really mandate renewals under certain circumstances? I mean, Louisiana did have a rule up until last year that said that if you were insured for 3 years or more, and nothing had changed, your insurer had to offer your renewal policy. And that law is gone, actually. The legislature undid it at the new commissioner's behest. So, as Steve said, a commissioner's personality can make a really big difference. And my point being, I don't know if the California legislature is going to go there or not. I think it really is one of the biggest obstacles to getting people to put time and money into reducing risk, making, fixing what they think ain't broke, replacing siding and changing out windows and taking down trees and spending that kind of time and money. If you're and then not getting rewarded is really making people angry. And we're hearing it all over the state. Like, I did what they said and they still dropped me. So on some level, I feel like we've got to fix that.
Steve, I saw you coil when you heard about mandatory renewal. What's going on there?
Yeah, sorry, I had to keep my head from exploding. So first off, I think it's important to understand the distinction in the insurance business and also just in the law between cancellation and non-renewal. An insurance contract is for a set period of time. Typically homeowners policies are 1 year, auto insurance policies are 6 months or a year, depending on the insurer. But once an insurance company has issued a policy, they are highly limited in their ability to cancel. If they say we're going to insure you for a set period of time, they have to do that. And the only exceptions are for non-payment of premium or fraud or some really major change in how the property or the vehicle or whatever else is being used. That's distinguished from non-renewal. Just because an insurance company has agreed to insure a piece of property for a given period of time doesn't mean they have to continue insuring that property in perpetuity, right? And insurance companies are very concerned, tend to be very strongly opposed to restrictions on their ability to underwrite, to provisions that would require them to continue writing policies because, again, we are in an environment where rates are not adequate. And so insurers are really strongly opposed to laws that require them to keep running policies where they're guaranteed to lose money. From a just public standpoint, from a consumer standpoint, from a health insurance marketplace standpoint, we think that's not the way to go. Now, I agree with Amy that the provision which actually then Senator Ricardo Lara authored when he was in the state Senate is very helpful. It says that when the governor has declared a state of emergency, the insurance commissioner is authorized to impose a 1-year moratorium on cancellations or non-renewals within both the zip codes of the designated area that the governor has identified and also all immediately adjoining zip codes. We support that law. We think it has been very helpful to consumers. And I would agree that there is a major loophole there, but it's not the one that Amy necessarily mentioned. And I'll tell you what the loophole is that we see. The thing about non-renewals is that insurance companies, although they can non-renew, they can decide not to continue to offer renewal for any reason they want. They are required to tell the consumer why if they've made a decision not to offer. And if the insurance company has not told the truth about that, then there is a remedy against the insurance company for that. They can file a complaint with the department, they can do other things. And so it may be that some insurers are making up reasons. I don't know. There is a remedy for that. And from what my members tell me, we don't believe that's widespread. But here's the loophole. The real loophole is that the commissioner's authority to oppose that moratorium dates in the commissioner's interpretation to the date the governor signs that emergency declaration. And the problem is there can be periods of days or even weeks between the onset of the fire and the declaration of the emergency. And we've seen insurance companies, wholesale just shotgun non-renewals in all areas of the fire zone and or even around it before the governor issues the declaration of emergency. So if we were going to tighten those laws, we honestly think that would be the way to do it. And I don't know exactly how you define that, but there is a period of time where consumers are completely unprotected. We'd like to see that remedy. In commercial lines, there is, as Amy mentioned, a bill that would extend commissioners' authority to impose these moratoria and on cancellation on renewal to commercial lines. We as agents brokers have not taken a position on that bill yet. We know that companies are very concerned about it again because there is just a phenomenon of rate inadequacy, and especially in commercial insurance, the potential losses and the potential inadequacy of the rates is maybe substantially larger. As I read that bill, it's not limited just to small business. It's any commercial insurance policy. So that's an issue that will be, certainly contested, and it'll be very interesting to see how the legislature deals with it.
Thank you, Steve and Amy. So State Farm recently had a significant increase. It moved 22% approved by the Department of Insurance. And my understanding is that there were conditions as part of that approval, that where State Farm, I think, agreed not to cancel policies. So a couple of things. The speed with which that increase was approved seems unusual, as well as the conditions. So let's start with Amy. Your thoughts on.
Yeah, that was a pretty interesting drama that played out in the public eye because we all knew that one of the rating agencies or two of them had downgraded State Farm. So we knew that the California subsidiary was definitely not in the most healthy condition. We also knew not only do they insure one out of every five homes in the state, which means they have a 1 in 5 kind of percent important role in the FAIR plan. They were one of the last men standing in a lot of the areas where we were teaching our classes, our, shop, well, we would, and where we've been doing these participating in town halls all over in a lot of these rural counties that for up until the Memorial Day 2023 announcement that where they said we're hitting pause on new business. Up until then, for like a year, they were the only other option. We were telling people, well, it's fair, you because we've had a really hard time recommending that consumers go with non-admitted insurers, right? It's been very hard for me as a consumer advocate to, suggest that people go with these very lightly regulated, not as accountable type insurers. So we knew that this California subsidiary wasn't maybe not in the best shape because of the downgrades. We also knew that, for them to publicly admit that they were not in great shape and basically say, we need this emergency rate increase and basically beg for help, that I just always kind of felt in my gut, well, this wouldn't be happening if they weren't really facing some very significant financial challenges. That said, that, there was a lot of people saying, "Well, why can't the, State Farm Mutual out of Illinois infuse more capital into State Farm General here in the state and/or were they overcharging them for reinsurance? Is this a shell game?" And there have been a lot of people, myself included, that have worried that the non-renewals were a political strategy to ratchet up pressure on the department to grant, rate increases faster and higher. And so then there was that leaked story that about the State Farm executive basically saying that like if we don't get this emergency rate increase, we're just going to not renew a lot more people. And from a business standpoint, I'm like, well, I get that. But my point being, I have to have confidence in the department's rate reg bureau. I have to have confidence that they are professionals that do their job and that they reviewed the documents and made a determination to the best of their ability that it was an appropriate request to grant, as painful as it is for everybody who's insured with State Farm, and as hard as it is for the commissioner, who, as you said, he's termed out, but still, he's on the firing line every day. Right? Great. I mean, there was a lot of pressure on him. So I think that he finessed it. The fact that Consumer Watchdog kind of went along with it is pretty amazing too. So I feel like that State Farm made a compelling case. And here in the United States, we let companies have subsidiaries and we let corporations have different units. We've seen, solutions brought, to that before.
Steve, what say you regarding the increase? It sounds like you may not differ too much from what Amy is saying, but
Yeah, well, let me say first, State Farm is not an independent agency company. Mercury is,
right, right.
and so we're happy to see Mercury come back and increase its presence for sure. I agree with Amy, honestly. I think Commissioner Lara and his staff deserve a lot of credit. I think they're absolutely asking the right questions And the requests for additional documentation, I think, are completely appropriate. There's going to be a hearing on April 8th, which will be a public rate hearing. And at that opportunity, at that hearing, the company will have to provide more data. And so the commissioner's sort of approval of this interim step is conditioned completely on what happens. So we don't know for sure exactly what will happen. The other two comments I would make are that one, it's hard to overestimate or overstate State Farm's importance in the overall insurance marketplace, like in the whole US. They are massive. They are massive. And the 20% figure of policies in California alone is just almost mind-boggling. It's so large and their
Right.
exposures are so huge. But the company nationwide is even bigger. And that's why State Farm General, the California subsidiary, can buy all of its reinsurance from its own corporate parent. And so the commissioner was put in a very, very difficult position. And again, I think he and his staff have threaded the needle, I think, pretty effectively. And we'll see what happens at the hearing on April 8th.
So one thing a lot of whenever I give out when I do talks about insurance market in California, one of the things that always comes up is they'll see or they'll hear in the media, especially, oh, so and so company, Allstate, whatever, give granted 30%. And I always have to explain it's not every policy going up 30%. Could you shed some light? And I'll start with Stephen on how that's determined. Like who gets the 60% increase, who gets the 2% increase?
Yeah. There is in the insurance world a very important distinction between a rate and a premium. The insurance companies have to get approval of rate increases. So if you get a 10%, or we'll use State Farm, a 22% rate increase, that means that rate increase is applied across the board to all of the policies in that particular type of insurance, homeowner insurance, or maybe it's renter's insurance, or maybe it's a commercial business owner's policy, whatever it may be. But the company then has to make decisions consistent with the authority that the commissioner has given it to then apply those increases across the board. I think Amy may have said earlier, in some cases, there might be rate decreases. In others, there may be rate increases. In some cases, the rate increases might be larger than 22%, but it balances out to 22% across the board. And, I'll just say that one of the reasons that we have been really supportive, especially of the commissioner's determination that insurance companies here, like everywhere else, should be permitted to use catastrophic modeling in rate making is that we think that actually has the opportunity to more accurately and fairly allocate risk because it just permits insurers to hone in on exactly where their exposures are the greatest. So ironically, when all these rules in effect, some homeowners, at least with respect to wildfire exposures, could see rate decreases. I'm not saying that's likely. I'm not saying hold your breath till that happens, but some homeowners will see very significant rate increases, but many will see either flat or maybe even lower rates because these tools will let out insurers better allocate the actual exposure to wildfire risks.
Amy?
One thing we really do need is for the models to do a better job at incorporating risk reductions that are actually taking place. So there are two types that we are pushing. And when I say we, it's not just United Policyholders. There's a lot of stakeholders that are, involved in this. And we want to make sure that those models start to really reflect the fact that utilities are spending in California, upgrading their equipment, using these more resistant, fire resistant wires and undergrounding and all that stuff. So we want to make sure that gets factored into the models. What areas are these wide scale risk reduction activities already in place? And that should actually get factored in. And also to reward the people in communities that are taking it seriously. Just like Steve was saying, that some people may see decreases. We want to see those models help advance the risk reduction work by rewarding it and by really being complete and so to that end, I'm working. It's an online resource center. It's a map, and anywhere in the state you can click on it and see what kind of mitigation help there might be in your community grants and that. And we're also now supporting something called the WUI Data Commons effort, which is basically an effort to get all of the information from fire departments and fire state councils all in one place so that insurers have a data set that they can use to do what we're asking them to do, just to really adjust their rates to acknowledge areas where risk is now lower and therefore that their rates should also be adjusted so that they're not, charging an excessive rate on a risk that's been reduced. But we acknowledge that there's a lot of work that has to happen for that to happen.
So, as I think, Amy, you previously mentioned, and probably also Stephen, that there's a lot of legislation pending, both in the Senate and the Assembly, and so many that it would be a separate podcast to talk about them all. So I'm going to ask you, Amy, to maybe identify one or two that you think are particularly, maybe helpful or will be good.
I mean, so far, we're just getting our letters in right this week. Things have been moving a little fast. It's pretty crazy. We support there's a to create a home hardening commission. Well, we basically need to institutionalize risk reduction, so that's important. There's also, as I mentioned, a bill that would extend the non-renewal moratorium just to commercial, which I think would be helpful. Again, it's a palliative. Those are two. There's a number of other bills related to mitigation that we think are all, again, sort of moving in the right direction. I think what remains to be seen is, are we going to see any kind of a measure that gives either the department or consumers some leverage, more leverage than they have now, to get an insurer to renew them
If they do
if they
those.
right.
Stephen, any particular pieces of legislation that stand out as helpful, harmful?
Well, we've talked about this, Sanjay, to some degree. And again, from our perspective, bills that would require insurance companies to take policies or that would require them to stay on policies forever are maybe politically very popular in terms of pandering to constituencies, but they would be absolutely injurious to the long-term health of the marketplace and very, very bad for consumers from our perspective. And I say that representing people who don't make a living if they don't sell policies. We want insurance companies back. We want them to be selling policies. We want them to do that. So it pains me to say that, but we are very concerned about that. Number two, again, these proposals in the legislature to mandate, like a take all comers provision, like we have in personal auto, would be absolutely disastrous. And the final thing I'll say is just about like home hardening and community hardening. Look, everybody supports that, right? But in order for insurance companies to be able to objectively apply credits, there has to be actuarial weight, actuarial credibility behind the measures that are taken and the sort of objective diminution of risk. I mean, I can take out a shrub that's that's outside a bedroom window. But if my neighbor doesn't do anything about the wood shake roof on the house that's 5 feet from mine, there's not gonna be any risk. There's not gonna be any diminution in value. And I don't mean to belittle efforts because, again, we want to encourage mitigation, but the part of the problem, Sanjay, as you know, and Amy, as you do too, is that the expense of doing what really is required to be done here, the political decisions that have to be made about where people build and what they can build, the consistent enforcement of the highest and best building code standards, all of those things are monumentally expensive to actually do. And I mean, just talk about forests. One of the reasons that we've been in this unbelievably disastrous wildfire sort of cycle since 2016 is that we now recognize that there are millions and millions and millions and millions and millions of dead trees in the forested lands and in the WUI, in the wildland urban interface. And no one's figured out how to effectively reduce that exposure. And the gift that comes from figuring out how to reduce the exposure is you then have to do it again 2 years later because everything grows back. So whether it's at that macro level or whether it's at the sort of micro lot or community level, we haven't figured out how to do that. It's imperative that we do it, but it's extraordinarily expensive. And so we are concerned about measures that would require insurance companies in an environment, again, where rates are already materially inadequate, that requires them to provide additional discounts that there isn't actuarial support or objective evidence to back up.
Any response to that, Amy?
Only that to say talk to people who are suddenly staring down the barrel of a $12,000 a year annual premium, it's hard to really say, yeah, rates are woefully inadequate. We have a tricky situation here, right? I think, like, I have been comfortable saying to people for years, the days of you paying $1,000 a year to insure your home are over. So I think people can get that. Most people get that. So, like, but people will say, all right, 5,000, even 6,000, but 10,000? 12,000? Come on, 18,000? So I think we've gotten out of whack here. I think, part of some of these sticker shock amazing prices people are getting is because we're allowing basically unregulated entities to come in and charge what they want, and they're capitalizing on a vacuum that the admitted carriers are leaving, and so they're coming in. I was at a insurance conference earlier this week, and I caught a cab back with somebody who's a consultant to the non-admitted carriers and she said, "Oh, I think the non-admitted carriers are gonna swamp the admitted carriers, and I'm like, "Well, that's a problem for a lot of reasons. They don't pay into the FAIR plan, they don't pay into the insolvency fund, their rates aren't regulated, and their forms aren't regulated, so that's not healthy. I mean, we don't want that." And I asked her, I said, "Do they pay premium taxes? Because like, do they? Because I think the regulatory agencies funded by premium taxes, right?" And she's like, "Well, some." I'm like, "Some?" Okay, so we do have a lot of work ahead of us here to really right the ship, and I hope we're on track. I mean, nobody wanted to see LA burn. It's absolutely awful. But the insurers definitely have the fiscal strength to meet their obligations there because we regulate and we keep an eye on their books and the sustainable insurance strategy is in place. And so we are moving into a new era. So hopefully, we'll be back on this show in another 6 months going, oh, the market's opened up quite a
Yeah.
bit, which is what we all want, to have happen.
So the next thing I just want to touch on is the FAIR plan. And in particular, partly because of the news stories, they're doing the $1 billion assessment. And the next day, the headlines were consumers on the hook for $500 million. So what's going to happen? Steve, and I'm not going to hold anybody to tight predictions here, but what's happening with this assessment, and what do you think will happen in terms of the possible consumer assessment?
Well, number one, in the face of this urban conflagration that we've experienced, by and large, I think both the FAIR Plan and just the insurance companies have acquitted themselves incredibly honorably and professionally. I mean, I don't know how many tens of thousands of, claims have already been filed, but the complaints for claims handling practices are relatively tiny. I mean, it's like a fraction of 1%. Now that doesn't help if you're in that fraction that can't get an answer from their fair plan, or you've got a company or an adjuster or someone who's screwing you around, or at least you feel like you're being screwed around. So I know it's no consolation to them, but by and large, the vast majority of claims are being paid. They're being paid at or even above, contractual limits. I think we have to recognize that in the face of very difficult circumstances, insurers have really done I think, a fabulous job so far. Amy will remember, the Berkeley Oakland Hills fires from the very early 1990s, and insurers were not prepared to deal with that. And we received many more complaints about delays and other things going on. So I think they've done a good job there. The commissioner last September issued kind of a landmark bulletin in which he said that in the event of an assessment, insurance companies could request permission to recoup a portion of those assessments. So on any assessment up to the $1 billion that has been authorized so far, insurers can request his permission to recoup half of that amount in the form of surcharges over 2 years. And so, assuming that the commissioner's authority to issue that bulletin is not challenged, we think that helps. There are other measures that are pending in the legislature right now that we think would help shore up the FAIR Plan's financial position even more solidly by letting them use the California State Bonding Agency to issue bonds, to get lines of credit from private financial institutions that could also be subject in the event of non-payment to assessment, and other things that we hope, that another assessment is not going to be likely. But again, the FAIR plan, for all of its challenges and for all of its continued growth, I mean, they've reported in an informational hearing in the Assembly Insurance Committee last week that they took more policies in February than they have in any other recorded month in their history. And they were getting something like 1,500 a day. I mean, that's an unbelievable workload for this small, little office. They beefed up, but they're still awfully small. So I think the FAIR plan, has done a pretty darn good job. And again, the point I would make though is that insurers, and by the way, this assessment is calculated on market share going back 2 years. So we look at 2023, and State Farm, for example, in homeowners insurance had 19.7% of the market. And of this assessment, 97% of it, I believe, is assessed against homeowners insurers. 3% is on commercial claims, commercial losses. But that means, State Farm is going to have 19.7% of 97% of, $1 billion in addition to all its own claims. So that's an awful lot of money to try to recoup, but they can't just do it. They have to submit a specific plan. Every other insurer does too, to the insurance commissioner and get that approved before the surcharges can be implemented.
Amy?
Well, look, it is true that considering the incredible demands that have been put on the FAIR plan, to take on this many more new customers it would be challenging to any entity. And I do appreciate that there are a lot of hardworking people there. I will say from what we're here out of LA is, they're doing some things right in terms of advancing, more than they even are legally required to. Like, I think they've been advancing 50% on dwelling, which they're not obligated to do, which is good. But on the smoke claims, there's a lot of criticism of the hard line position they're
Yeah.
taking on very, very limited coverage for smoke remediation. So that's causing a huge outcry, and there's just a lot going on in terms of the criticism. So I think for the FAIR plan, look, what I'd like to see more transparency with their management operations. Is you don't even it's impossible to even know if you're a member of the public who makes the decisions there, and there's no public meetings, there's no, the decisions are made behind closed doors. I mean, look, the assessment, no one's happy about that, that's for sure. And I think the good news is this gets spread. If it gets, it's getting spread so widely, it'll be relatively minor hit on people. I think, less than $100, I think, is one estimate I saw. But again, I don't think until we actually see it play out, we won't know. Not happy about it, but thank goodness we have that mechanism. That there's some really good things about our FAIR plan that other states don't have. It's not taxpayer funded, which really helps because part of what's driving a lot of the, let's depopulate Florida and Louisiana citizens at any cost, even if it means assigning people to startup insurers that have no track record, is because taxpayers are exposed, and that's a political liability for public officials. This is a different formula, which I
Yeah.
think is important.
For your general outlook, feelings about where we're gonna be in maybe a year or 2. Let's take 2027 if we do this again. Cautiously more optimistic, Steven? And then Amy?
Well, I think so. I sure hope so, Sanjay. I've said before, and I know your membership is feeling this too, Sanjay, but this is the most severe availability crisis that our members have ever experienced in their entire careers. I mean, it's been so long, and frankly, it was hitting independent agency companies and independent agency agent brokers because they tend to be smaller and I think more careful about what they're underwriting long before it sort of rose to the surface with State Farm and Allstate's division and all that. So our members have been complaining about this, for a really long time. And again, I think that the commissioner and his staff get a solid B for the reforms that they've actually implemented. There's some things that we, just don't agree with. We think they got totally wrong. But for the most part, we think they did an incredibly good job in trying to reconcile very major systemic reforms and fit it within the existing statutory and other legal framework in California. always putting consumer interest first and foremost at mind in terms of trying to create a better insurance market here. I tip my hat to Commissioner Lar and his staff. I think they've done a fabulous job. But as I've said before today, it's one thing to look at the new rules. It's another thing to know how they'll actually be implemented. And so everything depends on the discretion that the commissioner applies in approving insurers' plans to use these new tools and to start writing more policies. Everybody agrees that we've got to depopulate the FAIR plan. Nobody disagrees with that. But the problem is there's lots of problems with that. Number one is that the commissioner, with every best intention, has actually been expanding FAIR plan liabilities, not turning them down or slowing them down. There's an order right now which is being litigated in the Court of Appeal over his order to require the FAIR plan to write full-blown coverage, not just basic property insurance or basic fire insurance. And the FAIR plan takes the position that the commissioner doesn't have the authority to do that. I don't know if the FAIR plan's right about that or not, but that issue was almost certainly headed for the California Supreme Court, regardless of what the appellate court decides. There are some major things in the FAIR plan policy that are horribly, from our perspective, problematic. Amy mentioned, the smoke damage issue. The FAIR plan, put something into their policy a few years ago that requires permanent physical damage in order for any smoke damage benefits to be paid. And that's more severe than in standard homeowners policies. So the FAIR plan is, I believe, the subject of a class action litigation right now on that point alone. And there's some other issues without going too deep into insurance nerddom in this call, but the FAIR plan will sell policies on one of two different bases, either actual cash value or replacement cost. And on replacement cost policies, the FAIR plan requires, of course, consumers to estimate the potential replacement cost in the event of a total loss. There's a provision in the FAIR plan policy language. It's called the co-insurance clause that basically says that if at the time of a total loss, we find that your estimate is substantially below what it should have been, we will apply a pro rata reduction in claims payments, even beyond the fact that coverage is capped at about $3 million for residences. That's horribly problematic. I think a lot of consumers don't understand it. It puts agents, brokers in a horrible, almost guaranteed, nightmare situation. So we'd love to see, that issue remedied as well. And the last thing I'll say, just in response to something Amy said, we have so much respect for Victoria Roach, the president of the FAIR plan. She's an impossible job because, her board includes the insurance commissioner, includes the major CEOs of the insurance companies, and she has to figure out how to keep all of them happy. It's an absolutely win-less position. But she, I think, has done, at least in my experience, a better job at negotiating those very difficult battles. And also, she's done a better job at being more transparent about what the FAIR plan is doing than any predecessor I can ever remember. So I totally agree with Amy. It could be a lot better. But on the other hand, it's a whole lot better than it used to be. So I tip my hat to her and her staff as well.
So, Amy, an insurance industry B, an insurance agent's B to the commissioner. You don't have to grade. But Amy, what are your thoughts about where we should
I
be?
mean, I've got to give them an A minus. I would say that honestly, there have been more Monday morning quarterbacks in this situation than you could ever imagine, including former commissioners who, while they were serving, didn't have anything like these unprecedented marketplace conditions that he's dealing with now. So does he have a magic wand? No. Does anybody know? I literally don't think anybody else has brought forth any kind of a viable plan other than his sustainable insurance strategy. Other people would say, "Oh, well, he should suspend their license to sell, auto insurance." I was like, "And what's that going to do?" Or, and he should call their bluff. Oh, yeah, he's gonna call their He's like, "Have you heard of mortgages? Like, have you heard of the economy?" Like, no, okay? That kind of upheaval, especially given that insurers have made it very clear in other states, including Florida, that no one state is so valuable to them that they will not reduce their presence there. I think I'm going to have to like wrap up here and just say I think we should be on track, but this, climate change is here to stay and insure-tech is here to stay. And we've got a situation now where risk looks more risky to insurers, and that's just how it is. And so we're either going to have to bring some more public solutions, such as a public reinsurance facility to sort of supplement private reinsurance, but trying to play hardball with the insurers without there being any alternative for property owners, is doesn't make any sense. I agree with Steve that literally, like, I mean, Lucy Wang has worked her absolute tail off getting those regs right. I personally know she hasn't taken a weekend off in like a year. So anyway, with that, I would say they've taken their best shot. We're all trying to take our best shot. At least I certainly hope from my angle that we are. And I really do appreciate the opportunity to visit with you today, Sanjay.
Oh, yeah,
And Steve.
obviously, yes, Amy and Stephen, it's always a pleasure. And I think one thing, both of you have talked about, the sustainable insurance strategy is kind of the strategy that's there, and hopefully it works for us all. I think to some extent, everybody seems to recognize that, if only because all the legislation that's pending, none of them would do the kinds of things that both of you have kind of warned about or said would be a real problem, that could create that problem or really injure that strategy. So anyways, thank you again. And I'm sure we are going to have another one of these in the future. So I
I
look
look
forward
forward
to.
to it.
Yeah, same here, Sanjay. Thank you very much.
Thanks so much, gentlemen.
All
Thank
right.
you.
Disclaimer. The purpose of this podcast, brought to you by the California Association of Realtors, C.A.R., is to provide general and educational information and opinions from a wide range of perspectives regarding politics, voting, elections, legislative issues, and more. The opinions, beliefs, and views expressed by guests or participants of this podcast are solely their own and do not necessarily reflect the opinions, beliefs, or views of C.A.R., its affiliates, their respective directors, officers, or employees. Reference to any individual or entity does not constitute an endorsement, recommendation, or any other position or opinion regarding that entity or individual by C.A.R. This podcast does not constitute professional advice or services of any kind. This podcast is available for private, non-commercial use only. You may not edit, modify, or redistribute this podcast.